Welcome to this episode of ACG's Growth TV. Today, I'm joined from Toronto by Corpay's Chief Market Strategist, Karl Schamotta, who's here to talk about the impact of Russia's invasion of Ukraine on the middle market businesses and global M&A activity. Karl, this war between Russia and Ukraine has now been going on for over a week, and of course, first and foremost is a devastating human tragedy. It's also having an impact on the markets, creating a lot of turbulence in the public exchanges in particular. So, to what extent are privately held middle market businesses feeling the impact today?
Right. So I guess the big impact here is that financial conditions are tightening a little bit on a global basis, making deals slightly more difficult to do. Depends on how far you are separated essentially from the front lines. But if you look at what's happening in global markets, there's sort of a breakdown in trust. And that has to do with the fact that we don't know how these sanctions are going to be applied. There's considerable ambiguity about what sort of areas of the Russian economy are going to be affected and the Ukrainian economy. And all of that is meaning that we have more margin calls, we have less willingness to do deals, and that sort of cascading across the global network of companies that typically put deals together. So that's sort of the near and dear sort of issue. And then in the background, we also have the fact that central banks are taking this in, processing it, and interest rate expectations are shifting as a result. So this is a very, very complex environment. It is definitely dampening deal activity and having an impact across the global economy.
And you mentioned the international community has now imposed pretty significant sanctions on Russia. Given how intertwined the global financial system is, how can deal makers make sure they're not falling afoul of those sanctions during a cross-border deal? Are those lines pretty clearly drawn, or are there gray areas to watch out for?
Right. That's the real key question at this point. The big question I think for most participants right now is that we know that big swaths of the Russian economy are going to be allowed to operate as they did previously. Sanctions are not directly applied to many businesses within the Russian economy. But when we look at the commodity side, if we look at oil and gas, if we look at agricultural commodities, there's still a lot of ambiguity, and we don't know to what extent some of these sanctions might be amped up in the weeks to come. So what that really means is that if you are considering deals in these areas, you're not likely to find a dance partner right now. It's very, very unlikely that that a party is going to be willing to enter into a deal that does involve Russia or Ukraine. And then beyond that, of course, if you are in the commodity space, there's ambiguity regardless of where in the world you operate, because we don't know what's going to happen to supply and demand in the coming weeks. So, this is definitely something that that folks are going to have to watch for. The way I would sort of look at this is that it's a good time to keep your powder dry and to kind of take a step back from the table. Look at where the opportunities might be created in the longer run and position yourself accordingly. Don't panic and sort of respond to these really sort of scary headlines that are coming out and make decisions on that basis. That could be very, very dangerous. Beyond all of that, of course, we are looking at another round of currency volatility. So it makes sense to hedge yourself against some of the risks that might arise as exchange rates dislocate in the weeks to come.
And in terms of where opportunities might be created in the long run, where do you see those opportunities?
Well, definitely when we look at the commodity space in particular, there's clear opportunity here in the fact that we are looking at a less how do I put it a less smooth framework for moving goods and services globally. What has been learned in this entire episode is that governments can interfere in markets. They can put extreme barriers between countries in terms of moving goods and services, and that is going to lead to sort of a higher background level of commodity prices in the years to come. So, the energy sector looks extremely attractive at these levels. The fact that, that you are able to lock up supply in the US and Canada in some of these more geopolitically stable jurisdictions certainly looks attractive and certainly, could mean that an investment today pays off very, very well in the long run. Sort of capitalizing on that lack of investment that has happened in recent years could be very, very profitable over the years and decades to come.
And prices were rising even before this conflict, particularly in the consumer sector, in addition to commodities. Do you expect inflation to accelerate because of the war?
Yes. So in the coming weeks, we do expect prices to continue to rise, and that will feed over into your consumer price indices in most advanced economies. The euro area is going to get hit the hardest, clearly, with gas and oil prices skyrocketing and directly impacting the European economy. But we are likely to feel this in the US and Canada as well. And so the challenge here is that central banks are going to have to step back a bit, and wait for this to impact the economy and so that they can understand what's happening. But they aren't going to be able to respond that aggressively in terms of tightening rates. So in the coming months, higher inflation, but in the longer run, we might be looking at demand destruction. We might be looking at prices toppling quite quickly. And so, what we could be looking at is a really bifurcated market environment this year in which inflation skyrockets early in the year and then falls off quite rapidly later in the year. Very, very complex for anyone who has to manage interest rate risk.
And are there any other ripple effects from the war that we haven't talked about that viewers should be aware of? I'm thinking in particular of private equity investors or their portfolio companies.
Right. So I think that this is the first shot in a very protracted economic war. What has been shown here is that countries, nation states, are increasingly willing and able to pick up the tools of economic warfare to execute against geopolitical goals. What you're looking at in the years ahead is a more difficult environment in terms of moving money across borders, moving goods and services across borders, and moving people. And so this is going to reshape the investment landscape profoundly. It is going to mean that that era of globalization that we saw sort of accelerate since the fall of the Soviet Union in the early 90s is being brought to an end. That is very, very profound and will certainly shape where the greatest investment opportunities are over the next generation here.
Karl Schamotta, thank you for joining me on Growth TV.
Thank you.